been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education. Hey, Jason here. Today I'm going to answer a question verbally if you're watching this on YouTube, visually if you're watching this on YouTube, verbally if you're listening to this via the podcast. I earlier answered a question on Quora that somebody asked, do you have proof that cash flow is better than earnings? Okay. I took that as a little bit of a challenge, wanted to think about it, and obviously if you watch this at all, you know I think net income or earnings is crap for the most part. So I went through a scenario with this in this Quora answer, pretty long answer. I think it was probably around 1,000 words. And so I'm going to recap that information here for you because I think it's important. Because as deep value investors, we pretty much always look at cash flow to some degree. To me, it's one of the most important numbers, along with operating margin, free cash flow to sales margin, ROIC, stuff like that. It's one of the most important things that I look at personally. And I know that many value investors feel the same way. So I wanted to share this with you in case you would rather learn visually or audioly instead of reading something. So the scenario went down is let's say there's two companies. Company one has a net income of $1 million, which is earnings. Net income is earnings. Has a net income of $1 million. But it has to put 100% of its net income back into the business every year just to sustain the business, to buy new equipment, to upgrade equipment, to repair equipment, stuff like that. Pretty much all of their net income every year goes towards sustaining the business and buying equipment. That's where almost 100% of the value in their company is, in their equipment. This brings several problems. First, if a company has to do this and has zero money left over to do things like hiring new people, expanding operations, working to cut efficiencies, because that requires cost and time and knowledge to do that, and usually those people are higher skilled and you have to pay them. Also prevents you from expanding geographically based on your usage of just the net income. I'm not factoring that into this equation at all right now. We'll get to that in a little bit. This also means that it's sustaining the business. It's not growing the business. It's just maintaining the business. Has to use 100% of its capital to just maintain the business, not grow, not do anything except for sustain. If a company has to do this, it also means the company has zero margin of safety. Because if something comes up, let's say a piece of equipment breaks, and while it's still under warranty, great, you'll get your money back, or you get another piece of equipment, whatever. Let's say the company that you're buying the equipment from, they're back ordered by 3 months. So you're pretty much SOL for 3 months, and that side of the business comes to a halt. Zero income, zero revenue, whatever, for 3 months. Or you have to take out onerous debt on bad terms to sustain this operation. Again, I'm not talking about equity. I just want to keep things as simple as possible in this example. And I'll get to all of debt and more debt and equity stuff later. So there's no margin of safety. The company has zero. Sorry there, lost you. Got a message. So the company has essentially zero real world profits because it has to plow all of its money back into equipment. Almost 100% of the value of the company is within its equipment. And there's zero margin of safety. Plus, the company is just sustaining. Just sustaining. It's not growing. It's not doing anything. It's just sustaining its operations. Doesn't sound like a very good opportunity, correct? Second company works in the same industry, has same net income, $1 million, but because of their efficiencies they've got in their processes or whatever, they only have to use 80% of their net income for capital expenditures to sustain the business. So in other words, they have 20% left over, or $200,000 in this case, to reinvest in the business, to hire people, to work on gaining more efficiencies, to do more and better marketing, to expand geographically, whatever it wants to do. It has 20% more capital. So not only does this give the company two more options, it makes them safer as an investment because they have a margin of safety. It gives them massive optionality. If they do more and better marketing, hire people, create efficiencies, they're going to increase their profit margins and sales, revenue, and market share, and all these things compared to company one. Plus, let's say they earn, and I'm going to copy this from the, because I don't remember the exact numbers, I'm going to copy this and put it in the video below from the Quora answer. The numbers, it will increase the value of the company within 5 years if they can invest their $200,000 per year at a 10% rate per year. It'll increase the value of their company by about $1.3 million over a 5-year period, compared to company one, which is just stagnating at about $1 million a year. So there's all these things that prove cash flow is better than net income. So how does this work kind of on the balance sheet, income statement, cash flow statement, all that kind of stuff? Net income is on the income statement. You bring net income when you do the cash flow statement. You bring net income, which is the bottom line of the cash flow statement or the income statement. You bring it to the top line of the cash flow statement, and you add and subtract things like capital expenditures from there. Whatever is left over is your free cash flow. For company one, that is zero. For company two, in this scenario, this is $200,000 per year, earning 10% percentage points per year that they can invest. So company two is the far better investment in this case, all things remaining equal. Now, and I didn't talk about this in the Quora answer, company one, which will actually make things even worse. If company one, or when, because issues always come up, when an issue comes up, company one will either have to do one of two things. It will have to, or one of three things. It will have to put off buying equipment, which will lower revenue, lower profitability, that stuff. It'll have to issue debt, or it'll have to issue equity. And if it has to issue debt or equity, it will be on terms that are not favorable to the company, which will further decrease the value of the company. Or in the case of debt, make their costs rise even more, which will lower profitability even further. So company two, on the other hand, because they have a margin of safety, if something comes up, they won't be screwed. They can still either buy another piece of equipment if they need to in this scenario, put a rush on the order, buy from another supplier. They don't have to issue debt or equity on bad terms for them if they don't want to, while still investing in the company and investing at a 10% rate of return. So this gives, again, company two far more optionality, much bigger margin of safety, and makes company two far more valuable of the entity. So do these points necessarily prove, like the question asker on Quora asked? If they don't prove that cash flow is better, I don't know what does. And this is a simplified scenario. You can get even more further into things, talking about how cash flow or how net income is far easier to manipulate than cash flow. How net income isn't really a real world profitability metric because it doesn't count things like capital expenditures, stuff like that, which we just talked about a little bit. All these things. We could get way more complex, but I wanted to keep things as simple as possible in this answer to make things as easy to understand as possible, because the more ideal, especially with private businesses, because all public companies have cash flow statements. Was it 3-4 years ago, maybe 5 years ago max, I started talking to more private business owners and private companies, and almost zero of them have a cash flow statement, or if they do, they have never looked at it, which is just kind of crazy when I first came across it to me, because almost 100% of business owners focus on the P&L, of private business owners focus on the P&L, which is the equivalent of the income statement. That's fine, but to me, the cash flow statement and balance sheet should take about 90 to 95% of your mental bandwidth, strength, whatever you want to turn it. You should spend about 90 to 95% of your time when you're looking at those three statements on the cash flow statement and balance sheet. Why? Net income, again, income statement is far more easy to manipulate, doesn't show real world operational profitability, doesn't count things like capital expenditures, stuff like that. It doesn't, frankly, to me, show as much information, and almost all private business owners focus only on the P&L, or again, the income statement. I still actually, pretty much every client we talk to, they can get me their P&L like that, their balance sheet, pretty quickly. It takes them a little while to get the cash flow statement. And I understand why, because most people focus on earnings, which is net income, because it's A, it's easy, B, it's reported everywhere on a public company, stocks, and private business owners take their cues from private business or public businesses to a great degree, and fewer people talk about cash flow. But to me, cash flow is, if not the most important number, it's one of the most important numbers to look at. I don't look at net income for any of the companies I own at all, except for when I'm comparing it to things like cash flow, owner's earnings, or operating profit to show how bad it is as a number. So I hope you like this video. I hope you like the extra context that I didn't put in the Quora answer, which should be linked above, below, whatever you're watching on this video, or if you're watching on a podcast, should be in the description. Hopefully my team will put it in there. If you want to see that answer and whatever comments come after that, or after the answer gets posted, I'd love to hear your thoughts, or you can click on it and you should be able to see it and get some more context. If you're just watching on here or listening on the podcast, thanks for listening. I hope this brought you a ton of value. If you have any questions, comments, concerns, if I missed something, let me know. Again, I know I left some stuff out when it came to this analysis, but I wanted to keep, for the purposes of the Quora answer, I wanted to keep things as simple as possible. So I purposely left some stuff out, but if I left something out that you think is super important, let me know in the comments. And watch, or like, love, share, subscribe, and if you're watching on YouTube, make sure you hit the notification or the bell and the notification so you're notified every time I release a new video. If you're watching on or listening on a podcast, make sure you like, love, share, subscribe, all that stuff. Deeply appreciate it. Thanks for watching. Have a great day. Talk soon. Bye.